values are getting so low. It's incredible that, if you have a building with a $400 a foot in debt and the competing properties are selling for $200 a foot, there's no way you're going to be able to be competitive on the leasing front. So it's kind of a negative feedback loop that's occurring there that's causing, in both of those sectors, non-discretionary sellers. So I just was with a very active buyer of these B and C buildings, and they're buying buildings for under $200 a foot today. Those are the prices in the 1990s. I mean, it's crazy what is going on. People will look back on this time and say, wow, in 2025, why the heck didn't I buy everything in sight?
Ladies and gentlemen, my name is Jesse Fragale. You're listening to Working Capital, the real estate podcast. A returning guest today, I have Bob Knakal, broker extraordinaire, Chairman and CEO of BKREA. Bob, it's been since about August. It feels like yesterday, but how are things going?
Jesse, great to be with you. Thanks for having me on again. And you know what? Things are picking up just the way I anticipated they would. Back in February of 24, I said that 2025 would have the highest turnover volume of any year in the past 40 years. And so far we are on track for that prediction to be true. So it's been really great.
That's great. And for all of us that can't predict the market like you can, what were the indicators leading to that decision? I know we chatted about it, and I'll just insert here. If anybody wants to listen to that, you can go to YouTube, type in Bob Knakal or Working Capital, and you can listen to that episode. That was, like I said, August 2024, but a lot's changed. So yeah, what were the indicators, Bob? How did you guys come to that conclusion? Because it looks like a lot of what we've discussed kind of came true, panned out.
Yeah, well, a couple of things. One was that the market was behaving in a way unlike anything we had ever seen before, and that usually when things get challenging in the market, every property type is losing value. It's just to varying degrees. And that's the way it was during the savings and loan crisis in the early 90s, the recession in the early 2000s, the GFC, 08, 09, and the great slog that began in October of 15 and continued through the pandemic. And this time it's a little different. Different product sectors are performing very differently. Our retail sector is strong. Hotels are on fire. Industrial is doing well. Land is starting to make a comeback. And our multifamily market and B and C office markets are still challenged, facing political headwinds, supply-demand headwinds. And so those are the two biggest sectors in terms of number of buildings. So you have some sectors that are doing well, some sectors that are not doing well. Interest rates are higher. That's creating a dynamic where, for the first time in my recollection, and I've been doing this since 1984, we have a very robust group of discretionary sellers who are taking advantage of the upswing in those sectors, and at the same time, a robust collection of non-discretionary sellers that have no choice but to sell. And that situation has been created by having the longest period of below trend turnover that we've ever seen. If you look at Manhattan as a microcosm of New York, the prime Manhattan south of 96th Street, there's 27,649 buildings in that area. The average turnover rate's 2.6% of that stock over 40 years. And remarkably, that 2.6% average turnover was the average at the end of the 80s, at the end of the 90s, at the end of the noughts, and at the end of last decade. And the longest period we had seen previously where turnover was below trend was in the S&L crisis in the early 90s. Well, we have this, now we're going into the sixth year where turnover has been below trend. So there's a lot of pent up demand. So naturally, with certain sectors doing well, the people who wanted to sell but didn't sell during the years where things weren't so great in those sectors. Now we're taking advantage of these improvement that we've seen in market conditions in those sectors. But then you also have the sectors, multifamily sector here is more highly correlated to public policy than to supply and demand. And the public policy is going very, very against owners' interests. A lot of the debt on apartment buildings in New York at 3.5%. If you are refinancing those buildings, you have to put in 35% fresh cash, and your mortgage payment's going to double, or actually it's going to be higher because you are now paying an interest rate that is almost double, if not more than double. And then in the B and C office sector, tenant demand is still challenged. Values are getting so low. It's incredible that, if you have a building with a $400 a foot in debt and the competing properties are selling for $200 a foot, there's no way you're going to be able to be competitive on the leasing front. So it's kind of a negative feedback loop that's occurring there that's causing, in both of those sectors, non-discretionary sellers. So everything that we thought would happen, unfortunately, is happening, or fortunately. It's just very, very a high volume market, and lots to do, to say the least, Jesse.
Yeah, that makes sense. In terms of the multifamily piece, since we last spoke, you had an election. There's been a lot that's been happening on the kind of the global landscape from the U.S. Looking out, and other countries like ours looking in. In terms of the market, what we saw was the market, was starting to look like 2025 was going to be the base year of a new cycle. Multifamily looked like maybe it was starting to kind of develop a little bit more steam here. And then we have a lot of this geopolitical stuff happen, a lot of the political policies happen. So how much do you think that's going to play a factor in the short to medium term? And do you see that as something that's going to kind of iron out this year or next year, as some of the rhetoric hopefully dies down a little bit?
Yeah, it's really tough to say. I think we need to see what is going to be implemented and how long it'll be implemented for, and what the magnitude of that implementation will be. So I think it's too early to tell. I will tell you that, just in the past couple of weeks, I've gotten a couple of calls. I've got actually 3 emails from brokers, and these weren't directly to me. These are just mad broker blasts that have gone out wide. With brokers saying they're looking for manufacturing space for foreign companies, and requirements ranging from 100,000 to 300,000 feet, which I thought was kind of interesting. May just be a knee-jerk reaction to something, maybe a real thing. But I think it's way too soon to tell, and we need to let things play out and see how they unfold.
So what are your thoughts on that? Kind of my thinking. I've been telling clients for the last few months that it does feel like we're at the start of another cycle here, and all the subcategories of real estate on the commercial side, don't always go perfectly in sync with the cycle. But where do you think we're at right now? What's your outlook on just kind of more macro standpoint?
Yeah, I think generally, I think we are at or near the bottom. And about to turn in generally, but it's really impossible to use a broad brush to paint the market today, because each of these different sectors is moving in different directions. I think the retail market is very mature now, and definitely getting better, and has been getting better for a while. The hotel market just started getting better within the past few months, but now it's one of the hottest sectors in New York City. Tourism is good. Our supply of hotel rooms is down significantly. We have, out of a stock of 120,000 rooms, we had 30,000 rooms taken offline, basically because 16,000 rooms are occupied by migrants, or at least were occupied by migrants. 14,000 rooms have been converted to student housing and other uses. New York City has cracked down on Airbnb. So at the peak, we had 27,000 Airbnb rooms, only about 3,000 today. So a combination of these factors has exerted tremendous upward pressure on ADRs. Occupancies are way up, and the hotel market is just going gangbusters. So again, I think you have to look at each property sector separately and figure out what's going on in each.
So, and in doing so, if we go to the B and C on the office end, I'm curious to get the kind of New York perspective. I think last time we spoke, I feel like not only is Manhattan a microcosm of New York, but I feel like New York is a microcosm of a lot of major cities in North America. In terms of the B and C, what is New York looking like right now from a return to office standpoint? And then maybe if you could talk a little bit between the kind of trophy assets or the A-class buildings as opposed to the B and C, because we definitely see a divergence between the two, a pretty sharp one in our market.
Yeah, same here. And I will tell you that I am not an office leasing expert, so I'll share with you stuff that I've picked up tangentially. But from what I hear, the back to work dynamic in New York is better than most cities across the U.S. And it seems like leasing activity is picking up a little bit. That being said, we still have about 80 million square feet of office space empty in New York. So there's lots of slack to pick up. We're seeing B and C office product continue to go down in terms of pricing. I just was with a very active buyer of these B and C buildings, and they're buying buildings for under $200 a foot today. I mean, those are the prices in the 1990s. I mean, it's crazy what is going on. So I think that sector is challenged. As you said, you have to differentiate that from new construction Class A office, which is doing phenomenally well. But I think Class B and C is going to be disaggregated into three buckets. The stuff that will be upgraded and stay office, because every tenant can't pay $200 or $300 a foot in a new building. So there'll have to be some lower cost office options. Some of it will be converted to residential. We have a great tax abatement program called 467M here. It basically gives you no real estate taxes during your construction period, and then a 90% reduction in your real estate taxes for 35 years after you do the conversion to resi. So very compelling tax abatement policy that's going to help. And then some of these prices are getting so low that there's going to be a pretty healthy bucket of buildings that are simply going to be demolished, because even when you layer in demolition costs, you're still way below land value. So very interesting times ahead. And, we have a new rezoning that is in the midst of taking place, which we expect to be finalized within the next few months in Midtown South. That basically is going to turn the Garment Center into what has historically been a pretty grimy location and tough place to do business or live. It's going to be one of the hottest areas in town because half the buildings will be demolished in the next 10 years.
Yeah, that's interesting. So that was 467M. That's the rebate.
That's the tax abatement program for converting commercial space into residential space.
Yeah, we're starting to see in a lot of the markets that we're in, and our home market here, a lot of, I think the cities, municipalities are trying to put incentives in. Like right now, I think a big push is to scrap the office replacement for conversion, which is kind of ironic that there would be a need for it, given the fact that it's kind of going in that direction. But I think that the issue, and I'm sure it's the same in New York, the issue with us is the type of asset. As you know, we talked about this last time. There's only a handful of types of properties that conversion really makes sense. But the demolition, I guess, at a certain point, the cost makes sense to just demolish some of these buildings.
Yeah, well, Jesse, I was with a guy who is probably the number one converter of office space to residential in New York just the other day. And he said that 100% of office buildings can be converted to residential. 100%. There's not a building that physically cannot be converted. Clearly, you have to make the numbers work, but there's a price that works for every single building. So I thought that was encouraging and very interesting, especially coming from the guy who has done more of it than anybody else.
Yeah, I guess the question is, where is that inflection point get so expensive where the demolition makes more sense than the conversion?
Right.
Yeah. So in terms of the actual market data that you look at, do you track? A big question for myself is where the rubber meets the road in terms of the mortgages that we have in our market and in other markets. In that, like you said, when the cost of the debt is 400 a foot and the buildings are selling for 200, at a certain point when that debt matures, there's a decision that needs to be made. Do you have the maturities? Do you track that? Is there something coming up in 26, 27 where there's a percentage that are going to come due, and going to have to see how people navigate that?
Yeah, this time around in every down cycle, I've always done a lot of work focusing on lenders and trying to help them out of their problems. Back in the S&L crisis in the early 90s, banks went through a 2 or 3 year foreclosure process. They had REO departments. They hired brokers exclusively to sell those properties. Then during the early 2000s and the GFC, the lenders didn't want to go through that 2 or 3 year foreclosure process. So they hired brokers to sell the debt. And we got hired to sell a lot of the debt, and that was good business. More recently, what's happened is that the lenders kind of don't want anybody looking too closely at all the stuff they have on their books. So they've been making deals more quietly, going to their top clients and asking them if they wanted to buy notes at a discount. Only a relatively small percentage of assets have been put on the market with brokers. And it's very interesting the way the market is reacting to this. But it has not been a great business to focus on lenders today, not yet anyway. A lot of them have been extending, wanting to kind of make a deal, give a little bit of leeway to the borrower. And then, we just had an auction on a building that was taken back by the lender, and only one bidder showed up. A very, very well located, good property, selling for about 20% of what it had sold for previously. And it's pretty interesting what's going on out there.
Yeah, there's a lot changing fairly rapidly. I feel like in a lot of these markets. You mentioned a couple of these different times, early '90s, .com, the Great Recession. What's different now, or is there an approach that you're taking now during this time? Because the one thing that I think is kind of connects all of them is that there's a period of quite a bit of uncertainty, which we know the market does not love. But are you approaching this differently than you had in the past? And what does that look like for you and the team?
Yeah, well, I'm trying to take advantage. My new company, I've always tried to do things a little differently. So back in the Massey Knakal days in 1988, when we formed that firm, we had a geographic orientation towards the business, and that was a little different. Gave us a way to differentiate ourselves and gave us a competitive advantage. When I got on social media in January of 2023, I looked at the landscape, saw what brokers were doing, tried to do some different things that other people weren't doing, and that seems to have caught on. And now with my new brokerage company, which will be a year old in a couple of weeks, we've tried to take advantage of a very, very different landscape here from a development perspective. We have new tax abatement programs. We have new incentives. We have the City of Yes rezoning that took place. There are a number of things that have occurred that basically have created a level playing field, or having everybody start fresh again. And so I feel like I'm starting fresh, but with a 40-year track record. But the thing that I'm trying to do different this time around is, rather than do brokerage like a broker, I'm trying to do brokerage like a developer. So in-house, I have a zoning attorney, a zoning consultant, a data scientist, a policy guru, an architect, cost estimators, construction people. I mean, we can look at any opportunity, figure out how to maximize the value for our clients who are always the seller of the property. Looking at doing these conversions, look at an office building, and we can tell you whether it's more effective to do the conversion, rip it down, or keep it an office. And so that's what we're taking advantage of today. And the land sector and the conversion sector is still relatively in its infancy, although these conversions have been going on for decades. It's just now there's a lot more incentive to do them than ever before. And the need for these conversions has never been greater. We've never had so much vacant office, and we have a vacancy in a multifamily in New York is 1.4% today. So we desperately need the housing. So for a number of reasons, I think this approach is something that, it's working well for us. In less than a year, we've closed 8 deals. We have 34 exclusive listings, approaching $3 billion of exclusives. And most of those listings are either land sales or very, very heavy redevelopment, value add type real estate.
So I know the New York market decently well. I can say I'm pretty ignorant when it comes to development opportunities in New York. For those that don't, maybe don't know the market as well, what does that look like in New York? Because we think about New York and Manhattan as just towers everywhere, not a lot of developable land. What does that look like? Maybe walk us through that type of opportunity and the details there.
Well, Jess, we have hundreds of acres of rolling land here in New York City, and just kidding. We do have a lot of buildings, but it's remarkable how many older buildings we have that are 100, 150 years old that need to be demolished. And the way you create land in New York, for the most part, unless you have an existing parking lot, unless you have to buy up a bunch of smaller buildings, knock them down, and create a piece of land.
So you manufacture the land down there. You just got to knock a couple things down.
Yep.
So the analysis you do with something like that, you have a seller. Are these sellers? It sounds like you're educating them, where they might come to you thinking that there's one way that they're going to do disposition, but you come with this team and say, we'll do an analysis on this and kind of a more tactical approach and say, these are your options, and this is where we think the best value is. Is that right?
Yeah, and the interesting thing is these new policies and guidelines have changed so dramatically, and this is just since this City of Yes rezoning passed on December 5th. So it's still relatively fresh, but it's really difficult to get your arms around. And so we're going in and we're educating our clients. We hold seminars about City of Yes. We had Dan Garodnick, who's the head of the City Planning Commission, come in twice and give seminars to our clients. We had our policy and zoning SWAT team present. And people are just finally starting to learn about it. But we're going in and having these resources available to us has been a huge competitive advantage. We've gone in and often the developable density of a site that we come up with is higher than what other brokers come up with, because our team knows the things that you can do to increase the zoning density. And for instance, we just had a pitch that we won where everyone went in and told the seller they had 60,000 buildable feet. We went in and told them they had 74,000 buildable feet. And sure enough, there's 74,000 buildable feet on the site. So, things like that give us a little bit of a leg up, and we're just trying to press that advantage as much as we can.
So when we last spoke, like I said earlier, it was August. So BKREA is about a year old, you said now?
Yeah, August 2nd of 24.
Okay, so it was, we didn't talk too much about
I'm sorry,
the company.
April 2nd of 84. I misspoke. I'm sorry.
So I wanted to talk a little bit about the team. what's, first of all, we had a lot of people reach out after the last episode. You have a little bit of a cult following in our world, and a lot of people like that episode and wanted to just understand what Bob's plans are with the team, what the goal is over the next few years. It sounds like you guys are doing some interesting stuff already, but maybe we could talk a little bit more about the company itself.
Yeah, no, company is, it is a small company. It's going to be a small company. We have less than 20 people. I don't want to get more than 20. I want to stay relatively lean. The objective is twofold. The objective, number one, is to have fun. And the number two objective, which is the most important, is to help clients. Continue to only sell buildings, only represent sellers, only work on exclusives, and do everything we can to get absolutely the best results for our clients. It's always been our philosophy that the more we understand about what we're doing, the more we can educate the client, and the more we educate the client, a better decision they can make. And if we're helping clients make better decisions and getting great results from them, then we're doing something right. And that's really all we want to do. We want to, create great results for our clients and have fun doing it.
Yeah. What I like too is like you talked a little bit about this earlier, you are not averse to changing technology. It sounds like whether that's using technology in the real estate space. We touch a little bit about artificial intelligence on our last conversation. How do you see those technologies impacting our industry? How much are those going to be something that you really need to wrap your head around going forward for people my age and, even 10, 15 years younger than me in the industry?
Yeah, well, I think it's really important. I've said I think AI is going to change the world, and it is. That being said, I will tell you that the business fundamentally is the same exact business it was 40 years ago. If somebody wants to do a transaction in real estate, you want to help them do it. We have different strategies we use today. Different tools are available to us. AI certainly is a very powerful one. But if you use it correctly, it can make things much more effective and efficient. If you think about it, the prospecting and deal execution are two things that are nothing more than funneling processes. You're going from thousands of people to hundreds of people to dozens of people to a few, and AI is great for helping to make that a more efficient and effective process. Data interpretation is another big use that AI can be extraordinarily powerful with, provided you have good information. And over the longer period of time you have that information, and the methodology for calculating the information has been the same over that whole period of time, then AI is extraordinarily powerful. Most data sets in the industry are not very good, so it's going to be difficult to have that aspect of AI help. But certainly, I always have said AI is never going to replace anybody, but someone using AI may replace somebody that doesn't.
Fair enough. So I want to get your thoughts there. You mentioned prospecting, and I still have people to this day ask me if like that aren't in our industry that actually ask me if cold calling works, which it's funny from their perspective because if you're not in our industry, it sounds crazy that today you can still pick up the phone. However, everybody's got a little bit of a different spin on what they do, and sometimes different tools they utilize, whether it's emails. Building walking is, prior to COVID, something that still happened in Toronto. I know in New York is that you guys have a little bit more security on your buildings, emailing campaigns. What's your view on prospecting in terms of the tools you use and kind of the amount you're putting in, for younger people out there? I'd love to get your thoughts on that.
Sure. Well, I'll go to 40,000 feet on that one, Jesse. And I think when you talk about prospecting, you're really talking about market presence. And market presence is becoming known to market participants so that they know who you are and what you can do for them, such that when they want to transact, they think about calling you and you become top of mind with them. In order to do that, you have to have an expertise in something. You have to be able to articulate that expertise clearly, concisely, and need to constantly deliver something of value to the people that you're interacting with. But I always say it's not who you know, it's who knows you. And so, how do you get known? Well, there are a number of ways, and these all fall under the heading of market presence. And cold calling, or after you've been cold calling for a couple of years to hopefully the same group of people, it becomes prospect calling, not cold calling, because they're no longer cold calls. But making calls, that is the number one revenue generating activity that you can undertake. And I always tell people, block time out, chunks of time, 2-hour blocks, 3-hour blocks. You got to block it out 3 or 4 weeks in advance, or you won't have a spot in the calendar to put it in. But it's the calling. Then it's the email blast. Then it's text blasts. Then it's hard mail. Hard mail, very, very underrated. I think it's great. People get so many emails today, they're deleting indiscriminately, may not get through. Hard mail is big shelf life, very sticky. I like hard mail. You also want to be creating content, being on social media, going to networking events, doing all the things to be out in the marketplace so that people are aware of who you are, what you do, what you've done for other people. And so when they have a need, or when the need arises to do a transaction, they think about calling you. But that's all of those things fall under prospecting, and it's all market presence.
Yeah, it's funny. You see a lot of people in our industry that are successful that have a system, maybe unbeknownst to them, develop a system. But I think regardless of what you do, having a system, because I've seen individuals in our industry, and I'm sure you have too, that have used this type of software, that type of software. There's guys and gals that are still doing it on Excel, making calls. But as long as the system is repetitive and they're hitting all the points that you discussed, it really doesn't matter what tool you use. I mean, ones can be better than the other, but I think it's kind of the repetitive nature of that. And the other thing is not happening overnight. This is something that you build over years.
Yeah, and the best prospecting tool is the one that you actually use. And you have to make the calls. And I say there are a lot of people. The remarkable thing to me is I would bet that over 95% of brokers do not have a formal prospecting plan. And you still, if you've been around for a long time, you'd be very successful. You make millions of dollars a year. But I would argue that if you implemented a formal prospecting plan, you can make a heck of a lot more. Because the most important thing you can do in our industry is originate leads and originate new business. And if you're bringing new business in, every single company in the world will want you more than you want them. And that's the position that you want to be in. And how do you do that? You got to be making those calls all the time and meeting with people and doing all those market presence things so that you become known as the go-to person for a specific type of transaction in a specific market. And then you turn what can be a very volatile income stream into a more regular income stream, almost like an annuity.
Yeah, makes a lot of sense. Okay, we have to wrap it up here, Bob. Before we let you go, we talked a little bit about the opportunities out there. Is there anything that you see within the next couple years? I usually try not to go crystal ball too far ahead, but areas of opportunity. We talk a little bit about hoteling, but just generally in the market right now, opportunities that you see on the horizon.
Yeah, just generally, I think that at least in New York, and I assume it's like that in a lot of places around North America, I think it's the best buying opportunity of a lifetime. When you're buying buildings at the same price you could have bought them for 20 or 30 years ago, that's a buying opportunity in my mind. I mean, the market's always cyclical, and I think the political pendulum swings, the market cycles, and I think that 4 or 5 years from now, people will look back on this time and say, wow, in 2025, why the heck didn't I buy everything in sight? Here, I'm buying this building. I'm paying $700 a foot. I could have bought it for $200 a foot back in 2025. What was I thinking? I think there's going to be a lot of that. There always is, always will be.
My guest today has been Bob Knakal. Bob, thanks again for being part of Working Capital.
Jesse, thanks for having me on. It's always great to see you.